So real estate, always a big topic here at Milken. One company that has an expansive vantage point of both the debt and equity sides of the global real estate market is Hines. It is one of the largest privately held real estate investors and managers in the world. More than $90 billion in assets under management, 30 countries, and I got to say, it invests in all major property types. With more on where the company is finding opportunities in today's environment is David Steinbach. He's managing partner and global chief investment officer at Hines. I set you up. I know real estate, it's local, there's different asset classes, there's geography. Is there a big kind of narrative, though, around the picture right now?
Well, look, I think it's really important to understand that the public markets and private markets are in a very different place. And, the public markets are having their own cycle, which we're dealing with right now with the tariffs and a lot of questions. The private markets, meanwhile, especially real estate, have been really bottoming out this last few quarters, last year, on the back of 500 basis points of interest rate increases. And so that really has caused the industry to reset. So it's in a much different place. The big picture, though, when you look forward and look at what looks like is going to be a bit more of a lower growth, higher rates environment, maybe even stagflation environment, the thing that's most on my mind is the lack of new development that's occurring. And I think that's something the market's not really paying attention to, and it's going to have consequences down the road.
We talked about this on the panel in terms of tariffs and trade disruptions, that when you're going to build a project, right, you've got to have a big development. You've got to have everything in place. Otherwise, you're going to be held up. You're thinking about that before committing maybe to new business.
It's that, but it's also more fundamentally the math, right? Okay. So whenever you do a new development, it needs to financially make sense, right? And we look for between 150 and 200 basis points of spread off of, you call it an acquisition. And with the increase of interest rates,
so buying versus building.
Right, exactly. And this is definitely more of a buy moment. And I think investors, if they are taking action now and buying now, it's a decision they won't regret, as the pipeline of your development is so small going forward.
But geographically speaking, and particularly, I think about, I was just in Washington, D.C. I was talking with some real estate developers there. There's a lot of concerns about economic conditions there and whether that is right for that long-term investment. And then, I go down to Texas and I was in Houston and, everything's just booming and, people can't build things fast enough. So where are those geographic discrepancies?
Yeah. So the first from a global lens, certainly the sentiment in Europe, in our view, has changed quite a bit in the last few months. The environment since January, and I was in Davos, and the environment there was much more optimistic in the United States and pessimistic on Europe. That dynamic has really flipped. And I felt that here the last 2 days at Milken.
Yeah.
I think the environment in Europe is actually seeing a lot more spending coming down the line. I think what's happening and the geopolitics has brought Europe a bit more together. And I think the spending is something that means that there's going to be a lot of investment opportunity. In the United States, obviously depends on where, right? The different geographies are going to be impacted in different ways. The Port of LA is going to have, a certain impact given what's happening in shipping. But meanwhile, there's going to be new corridors of demand that get created. There's a lot of more in the center of the country ports and other areas where it'll pick up new trade corridors that are going to get reemerge on the other side of this.
And you think that these will be long-lasting structural changes? These aren't going to be sort of Band-Aid stopgap solutions that might snap back once potentially we get more stability on trade?
I think what's happened right now is something that is going to change forever the market. I think this is one of these structural changes that have occurred. And I think, once you squeeze all the toothpaste out of the tube, it's really hard to put it all back.
Yeah.
So I think we're in a world of higher friction costs for global trade. I think that's an opportunity. I think the market will figure out the ways to make money and how to attack that.
Yeah.
But without question, I think we're in a different operating environment.
He's really good. You should do a panel with him.
I've done several panels. Middle East. Disney, Oprah said big news today, going to do a theme park over in the Middle East. I'm just curious, what is going on there?
Yeah, I think the Middle East, and certainly we work all around the world, and I think the Middle East is actually going to be one of the areas that see benefit from what's happening as trade routes get rerouted. I think the Middle East is going to be a beneficiary of that. And that's certainly what we're feeling on the ground.
I want to go to something on the panel, too. And I don't know whether it's Barry Sternlicht who was on the panel, too. As you know, rather entertainment, but talked about the West Coast ports. That maybe we're not realizing the impact that ultimately, longer term, they're not going to be as important going forward. You agree?
I do think there is going to be some rebalancing. I think that, certainly it's going to have a down cycle. I think, we're a very creative economy, creative country. The Los Angeles is a very creative place. They'll figure a way out. So I'm not I don't think we should see this in just a negative light. I think certainly there's going to be near-term hits, and we should be honest and very eyes wide open into that. But longer term, these things will figure themselves out. But near term, I do think there will be new opportunities in new parts of the country that will pick up some of the slack and see new trading partners as an opportunity as well outside of China.
And you think that will be a net benefit, particularly for your business and for your peers as well?
I think, look, I mean, what's happening right now is we're unable to build as much as I think the market needs. The U.S. is 2 million houses short. I mean, I can go through the list of things that we need that we're not able to build because the math is not working right now. It does mean that if you have a project where the math is working, I think that is a fantastic opportunity. It does mean that you should be buying real estate into this cycle because, again, you're going to own something that'll be more valuable. Yeah. And it does mean that in a world of a bit higher inflation and this kind of new deglobalized world, real assets is set to perform very well.
They are, but if you're starting a new project, say today, how do you factor in the financing, the relatively higher financing cost to start that now without knowing exactly where we're even going to go just even a year from now?
Right. Yeah. So there's several elements to that. I mean, just at the big picture, obviously the math, you have a capital stack that has equity and debt, and we need debt just to be stabilized. You know, I don't need it to come down significantly or up, but then you need the rents to justify the new development. And that's kind of this piece of the market that we're in this liminal space of, where we're not quite seeing that yet, but you know it's going to come given what's happening.
All right, I'm going to make you go there. Like, do you have a favorite real estate investment bet right now in this environment? Go anywhere in the world, go to any type of asset class, you know, within real estate.
Look, living is my number one conviction right now. I think residential. But you have to think about it.
U.S., elsewhere?
Well, all over the world.
Okay.
I am long in the U.S. So again, the U.S. is 2 million houses short, and so I think that asset class performs really well in higher inflation environments. It's usually first in, first out, given you've got 1-year leases that mark to market constantly, and so it's a great way to play the market. I also think in moments of uncertainty, which is kind of what the consumer's facing right now, they do tilt towards renting instead of buying, and so I think that is going to increase some demand here in the near term as some increased concerns on the economy near term.
This is why we want to talk to him.
David's great. David Steinbach, he's the CIO at Hines.